Do not buy these 3 monthly dividend ETFs unless you fit the conditions we'll cover in this video. For those who make it to the end, somewhere in this video, I'll tell you one more ETF to avoid. We talked about covered call ETFs on this channel before, but these are, in my opinion, the worst ones offered. These ETFs are the Global X ETFs QYLD, XYLD, and RYLD. They each track one of the major indexes. QYLD tracks the NASDAQ, XYLD tracks the S&P, and RYLD tracks the Russell 2000. Each of them buys all the stocks in their respective index and writes covered calls against those shares for additional premium income. Here's why you should avoid them. For starters, the covered call is written in a way that deprives you, the investor, of any real chance at capital appreciation. The call options are written ATM or at the money, so at the moment they're written, the shares are already at the strike price, meaning they're already worth the signing unless the index they're tracking is going down. This is done to provide the most premium income possible since ATM contracts sell for higher premiums, but those premiums come at the expense of any appreciation in the underlying shares. If that weren't bad enough, they don't even buy back options to close out the contract to prevent assignment and protect appreciation. This might explain why QYLD's current share price is just below the IPO price. RYLD hasn't done much better either, but on the other hand, XYLD actually did appreciate an entire $11 per share over the past decade. The cherry on top is the high expense ratio of 0.6%. This is higher than all the JP Morgan ETFs we've covered on this channel before. For those of you who made it this far, here is your bonus ETF to avoid. This one is also offered by Global X, but it's not a covered call ETF. However, its price returns have performed about as poorly as the other ETFs in this video. This ETF buys the top 100 highest paying dividend securities worldwide in an attempt to provide the highest dividend income possible without the risk of assignment from covered calls. However, both the share price and their dividends have trended downward over the past 5 years, making this anything but an ideal investment despite the high dividend yield advertised on Webull. Webull link is down below. This is the Global X Super Dividend ETF, ticker symbol SDIV. At this point, I'm sure you're wondering who would actually want these ETFs considering all the cons I've just laid out. In my opinion, the only type of investor who could benefit from these Global X ETFs might be a retiree who just wants as much cash flow as they can get. While they might not care about appreciation due to their age, they would still be better off owning something like JEPI or JEPQ for the lower expense ratios and the better tax treatment from qualified dividends with those ETFs rather than the ordinary dividends from the Global X ETFs. If you liked this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell so you don't miss a single video. As always, this is not financial advice. Do your own due diligence before investing into anything.